knowing your investment options is one of the best things that you can do to prepare yourself for the future and become a master of your cash flow. That's why in this video today, I'm going to explain the Roth IRA to you and let you know pretty much everything that you realistically need to know about the Roth IRA, including its history, how it works, its tax advantages, and so much more. The first thing that I want to talk about is just the brief history of the Roth IRA. So the Roth IRA was created in 1997, and it was named after a former senator known as William Roth. And this is a individual retirement account, so it was created in order to help people save for their retirement. And one of the best benefits about individual retirement accounts in general, including the Roth, is that you have a pretty much unlimited options on what you can invest in within that account, because it is just an account where you can store money and you have tax advantages of putting money in that account. The way the Roth IRA works is that it is funded with after-tax money, which basically means that it doesn't have a tax deduction for the year that you contribute to that Roth IRA account. So if you put money into a Roth IRA, you're not going to get any special tax deduction today or this tax year. And then while the money is within the account, if you have any kind of growth within that account, say your investments appreciate in value, you get paid in dividends or what have you, you don't pay any taxes on that amount. Any of your earnings are tax-free. And then once you go to take that money out, when it's designed to when you're retired, once you go to take that money out of that account, you actually don't pay any income taxes on it or any taxes on that amount at all. So basically, you put money into the Roth IRA, you pay taxes on that money. While that money is within the account, it grows tax-free. And then when you withdraw that money, you don't pay any taxes on it as well. So this is pretty much almost the opposite of a traditional IRA. But one really important part of withdrawals when it comes to Roth IRAs is that the amounts that you contribute to the Roth IRA, you can withdraw at any time. So contributions you make can be taken out anytime, tax-free and penalty-free, because that money was already taxed. So let's say you put in $5,000 into a Roth IRA this year. Well, next year, you can take out that $5,000 from that Roth IRA, tax-free, penalty-free, no matter what your age is or what your circumstances are, provided that the amount is still worth at least $5,000, of course. If you have earnings within that account, those do not follow under those same rules. So I'm just talking about contributions. If you have gains within the account, those generally can't be taken out without paying a penalty or taxes. So that is really unique with the Roth IRA when it comes to those withdrawals, because the same cannot be said, generally speaking, about the traditional IRA. And knowing all of your options is really important. That is why on this channel with On Cash Flow, I seek to explore all of our options when it comes to investing and saving our money. And we try to explore what is going to be the best options for you. And if you are liking this particular video, don't forget to like it and give it a thumbs up. It really helps me out and I really do appreciate it. While at the same time, if you want more content like this every single week, then don't forget to subscribe to the channel, because every single week I'm putting out new information when it comes to personal finance, and I just know that there is something that I can help you with. But getting back to the Roth IRA, contribution limits are really important to know. And for this year, which is 2020, for the 2020 tax year, you can put up to $6,000 into a Roth IRA. However, if you are over the age of 50, you can do what is known as a catch-up contribution. And that means you can add in an additional $1,000. So for most people, it is $6,000. And then if you're over age 50, you can put up to $7,000 maximum in your account. And this is true for both the Roth and the traditional. But one unique benefit that an IRA has that you don't really get with a 401k, so like an employer-sponsored retirement account, individual retirement account is something that you open on your own. One unique benefit that you have is that you can contribute to the Roth IRA or an IRA in general up until you file your taxes or the tax filing deadline, whichever comes first. So for example, you can still contribute to a 2020 IRA, like for that tax year, up until usually April 15th of the next year. So let's say the deadline is April 15th, 2021, you can contribute to your 2020 Roth IRA up until that deadline, or unless you file your taxes for that previous tax year earlier. Now, when it comes to those contributions, it's important to know what kind of money you can contribute to your IRA, because usually with IRAs, including the Roth IRA, you can only contribute with earned income. And that means typically money that you either make through wages, from your W-2, or money you make in profit from self-employment or something similar to that. So it can only be earned income, generally speaking, that you can contribute to a Roth IRA. You can't contribute money such as like money you earned from interest from the bank or money you earned from passive real estate investing or anything other like that. It generally has to be earned income that you use to contribute to these Roth IRA accounts. But if you are married and you have a spouse maybe that doesn't work or doesn't earn that much income per year, you can actually contribute on behalf of your spouse. So that means that a couple that is married, they can contribute up to $6,000 each, or one spouse can contribute up to $12,000, $6,000 for their account and $6,000 on behalf of their spouse. And then of course, if they're over the age of 50, you can add $1,000 to each of their accounts for a possible total of $14,000. So that is really cool about the Roth IRAs. But additionally, there are some other ways that you can get money into a Roth IRA account. So your regular contributions, we already talked about that. That's a really important part about getting money into there. But you can also do what's called either a conversion or you can do a rollover. So let's first talk about conversions. If you want to get money into your Roth IRA via a conversion, that means you are going to convert different kind of money into that Roth IRA. So let's say that you have a traditional 401k at your previous employer, and then you left that employer, you went and worked somewhere else. Well, that money that was in that 401k, you can put that into a different account. And if you want to convert it into Roth IRA money, you can do so. However, since the traditional amount, the traditional money in that traditional 401k was pre-tax, you're going to have to pay taxes on the amount that you roll over into the Roth IRA. So if you have $10,000 in your 401k and you convert it into your Roth IRA, that $10,000 is then going to be triggered as an additional $10,000 worth of income that you're going to have to file in the tax year that you do that conversion. So the conversion is basically transforming traditional money into Roth money. Whereas if you were to roll over money into that Roth IRA, what you would be doing is you would be taking the same kind of money and then putting it into the same kind of account. So in this case, if you had a Roth 401k at work, you could roll over that Roth money from the Roth 401k into the Roth IRA, and then you wouldn't pay any taxes on it because it's the same type of account, it's the same tax treatment. Roth to Roth, or even like if you're doing traditional to traditional, that would be a rollover. But if you're converting, traditional into Roth, then that would be a conversion and not a rollover. So those are two other ways that you can actually get money into your Roth IRA account. And if you roll over or you do a conversion, that doesn't count against your regular contributions. So you can still do your regular $6,000 and you can, convert or roll over from a different account into your Roth IRA, and it doesn't affect that contribution amount. A Roth IRA can be a really cool tool for saving for retirement and for building your wealth because all that money that is in there is yours. It is tax-free, and you can theoretically withdraw it all once you hit the eligible requirements like the age requirement and not have to pay any taxes on it. But there is a limit on who can actually contribute to a Roth IRA, and the way it is limited is in how much money you make per year. So right now in 2020, for this tax year, the income limit, if you are single, is $139,000. So if you make more than that, and I believe that's adjusted gross income, if your adjusted gross income is more than $139,000 while you are single, then you are completely phased out and you are not allowed to contribute to a Roth IRA. Now, it does begin to phase out before that amount, but the $139,000 is the maximum amount. That's where you cut off from the Roth IRA. If you are married filing jointly, that amount is $206,000. So once you get to over $206,000, then you can't contribute to the Roth IRA, theoretically. Now, there is a method called the backdoor Roth IRA, which is basically a way of getting money into a Roth IRA, even if you are over those income limits. But that's not what this video is all about. But it is something worth exploring if that unique situation applies to you. Because another really cool thing about Roth IRAs is that they are kind of very different from traditional IRAs in the fact that there are no required minimum distributions, also known as RMDs. So typically, like right now, recently, the traditional accounts, like a traditional IRA, you have to withdraw a certain amount from that account. Once you reach age 72, there's a certain percentage of your traditional account that you have to withdraw. So you're basically forced to withdraw, a certain amount. That's why it's called a required minimum distribution. But Roth IRAs, they do not have those same rules. So theoretically, you could leave money in a Roth IRA, forever and never have to withdraw from it, and then pass it on to your heirs or something like that, whatever you wish. Another important aspect of the Roth IRA is that pretty much anyone of any age can open a Roth IRA as long as they have earned income. So for example, if you have a family business, you can have your children working for the family business, provided you follow, labor laws and things like that. Theoretically, they could work for your business and they can contribute money to a Roth IRA at a very young age. So that could really help them get a head start on building their net worth if you are in a position to do that. While at the same time, one of the biggest reasons why most people favor the Roth IRA highly over, say, the traditional version is that they expect that their income taxes are going to be higher than they are now when they go to retire. So a general rule of thumb in personal finance that may or may not be applicable to you is that if you expect your taxes, your income taxes, your federal income taxes, to be higher in the future when you are retired, then usually the Roth IRA is a better option. However, the reverse is usually true for a traditional IRA. So if you expect that your taxes are higher now than in the future, then you should do traditional and vice versa. Now, that doesn't apply to every single person, like I said, but that is one of those rules of thumb in personal finance that kind of applies to maybe most people in most standard circumstances. But here's the thing, you watching this right now, you don't have a standard circumstance. You are far from ordinary and far from average. And that's why it is very imperative that you watch this video that I created about how to achieve financial independence in 10 years or less if you have not already, because in that video, I teach you to become a master of your own cash flow and take control of your financial life in the strongest way possible. Thank you so much for watching this video. Please don't forget to like this video and subscribe to the channel if you want more information on personal finance every single week, and I hope to see you next time.